Hello, sir. Nathaniel Dove from Global News. Prime Minister, we're looking for more information on the deal to open the Gordie Howe Bridge. Canada spent $6.4 billion to build it. Is the Canadian debt repayment on the bridge included as expenses before profits are split with the U.S.?
Well, let me say, first of all, that we're very pleased that the prospect of the bridge reopening later this month, or opening later this month. This is good for Canada, good for the United States, both in the short term and the long term. What we have with the agreement with the U.S. Is as follows. And let me start with what it isn't. It's not splitting the tolls of the bridge. It is an agreement for 15 years to split net revenues. Splitting of tolls, any sharing of the toll revenue won't happen until all of the debt is repaid. We will split net revenues over the course of the first 15 years, and those net revenues are after operational costs. So it's manning the toll booths, it's maintenance, it's snow removal, a series of other operational costs. We expect that after those costs, for the first few years, net revenues will be modest. In fact, we expect them to be negative, as traffic ramps up. So negative to modest in the first few years. And what's been designed is an alignment of incentives so that when the splitting begins, all of the portions that go to the U.S. government will be reinvested in economic development, regional economic development in the area, the U.S. side of the area, obviously, which is pro-cyclical. It reinforces, more traffic, higher revenues, more investment, and that's the way it moves forward. The underlying agreement that we have with Michigan remains the same. And so no sharing of tolls until all the debt is repaid. So it's a good deal for both sides. It gets things moving, and that's in the spirit of today's announcement, which is to get things moving.
Are you able to provide more information about the deal? Some sources to us and to Bloomberg and Reuters are saying it's a 50% split, I guess, once the sharing starts happening. And if this is a Canadian project, why did you have to start giving? Why did you decide to start giving some of the revenue away?
The first thing is you quoted the overall amount of the capital investment of the project, around $6.5 billion. What we're talking about is very modest relative to the size of that. Okay, that's the first thing, just to give a sense. The second is that, as I'm going to repeat myself, but I think it's an important point, that it's aligned, the incentives are aligned here because the reinvestment in regional economic development on the Michigan side, mainly the Michigan side, that's obviously good for Michigan, but it's also good for Canada because it's going to reinforce the traffic. So we see the incentive alignment as a reasonable discussion. It's a good deal for Canada, good for the U.S., and it's great for both countries to have this bridge open, and we're looking forward to
That's the clearest explanation we've gotten yet on the Gordie Howe Bridge deal, and it's an update worth sitting with if you watched our earlier video on this. It's not 50% of profits changing hands, as some reports suggested. It's net revenue, meaning debt repayment comes first, in full, before a single dollar gets split. For the first several years, Carney is telling reporters directly the number could realistically be negative. That's about as strong a version of, this costs Canada almost nothing early on, as you're going to get from a prime minister on the record. This press conference wasn't actually about the bridge. It was called to announce something much bigger, a nearly $2 billion investment in a new fleet of Canadian-built armored vehicles, and it fits into a pattern that's been accelerating for weeks. Standing at General Dynamics Land Systems Canada's factory in London, Ontario, Carney confirmed the government is investing close to $2 billion over 4 years to build and deliver 190 new armored combat support vehicles, expanding Canada's total fleet to 550. Every single one will be built at that London factory, sustaining more than 6,000 high-paying Canadian jobs a year for the next 8 years. And that's before counting the wider supply chain, which already supports over 10,000 jobs nationwide, from cable and wire harness technicians in Richmond, Ontario, to steel workers building armor plating in Regina, to thermal imaging engineers in Quebec, to specialized electricians in Nova Scotia. Carney framed this as one piece of a formal defense industrial strategy built around 3 words: build, partner, Buy. Build in Canada wherever Canada has the capability, like this GDLS deal. Partner with trusted allies when Canada doesn't have the capability alone, like the recent agreement to bring Saab's globalized surveillance aircraft into Canadian production, a deal that already includes a commitment to manufacture a third of the aircraft's entire global fleet on Canadian soil. And buy from allies when building or partnering isn't realistic, but always with conditions attached that force reinvestment back into Canada's own industrial base. Exactly the model behind last week's submarine deal, where 100% of the contract's value has to be matched with Canadian investment. Reporters pushed hard on something else. This part of Ontario has some of the highest unemployment in the country, and a defense contract alone doesn't fix that overnight. Carney's answer leaned on predictability as much as the dollar figure itself, arguing that long-term, guaranteed government partnerships give companies like GDLS the confidence to invest further, build out supply chains, and pursue export markets, since roughly 80% of what this factory produces already ships internationally. He paired that with a policy change most people missed entirely. Canada just passed a new manufacturing tax deduction covering plant equipment, R&D, and technology investment, pushing the effective tax rate on new manufacturing investment in Canada to less than half the G7 average and 4 percentage points below the United States. Not every question was about defense or jobs. A CBC reporter, with smoke from central Canada's wildfires still hanging in the air outside, asked Carney directly why his government is approving a new oil pipeline in the middle of a climate crisis playing out in real time. Carney didn't back away from the contradiction. He argued the pipeline itself comes with real conditions attached: a companion emissions reduction project equivalent to removing 90% of the vehicles currently on Alberta's roads, a 75% cut in methane emissions, and reforms to fix a carbon market where the legislated price sits above $100, but the actual market price had collapsed to around $20. A gap, he said, represented years of climate policy that looked strong on paper, but wasn't actually reducing emissions in practice. Asked repeatedly about Washington tariffs and an unpredictable trading partner, Carney kept coming back to the same idea in different forms. Canada is focusing on what it can control, rather than waiting on decisions out of Washington. It showed up in his answer on regional jobs. It showed up in his answer on the bridge deal. It's clearly not an accident. It's the organizing idea behind almost everything this government has announced over the past month, from submarines to surveillance aircraft to armored vehicles to interprovincial trade barriers. Add it all up, and this wasn't really a story about one factory in London, Ontario. It was Canada quietly building an entire economic and industrial strategy specifically designed to need Washington's cooperation less every year, while still being careful enough to call the deals that come out of it good for both sides. Do you think this build partner buy strategy actually reduces Canada's dependence on the US, or is it more message than substance? Subscribe to Unbiased Canada, hit like, and let us know in the comments.